On March 15th, 2023, a quiet announcement appeared on Bloomberg terminals worldwide. Saudi Arabia's finance ministry confirmed it would accept Chinese yuan for oil sales to China. No press conference, no presidential statement, just a single paragraph buried in the business section. In newsrooms across America, this got maybe 30 seconds of coverage. Producers moved on to crime stories and celebrity gossip. Finance journalists wrote brief articles that almost nobody read. The story vanished by the next morning. But in finance ministries across 5 continents, officials sat up straighter. Phone calls were made, meetings were scheduled, because everyone who understood global monetary architecture knew what that announcement actually meant. For 50 years since 1973, oil was priced and sold exclusively in US dollars. Every barrel, every tanker, every transaction. This wasn't just tradition, it was the foundation of American financial power. The petrodollar system forced every country on earth to hold dollars. To buy oil, you needed dollars. To get dollars, you bought US Treasury bonds. This created permanent structural demand for American currency and debt. Saudi Arabia accepting yuan shattered that monopoly. Not immediately, not completely, but the crack appeared, and once a monopoly cracks, it cannot be uncracked. Here's what most people don't understand about how currencies lose power. The dollar will not collapse the way you see in movies. There will be no single day when the president appears on television to announce the dollar is worthless. No bank runs, no wheelbarrows of cash, no Mad Max dystopia. The real endgame looks nothing like that. The real endgame is quiet, it's technical, it's boring. It happens in decisions made by finance ministers in countries you've never thought about. A central bank in Singapore adjusting its reserve allocation by 3%. A trade agreement between Brazil and China that settles in local currencies. An insurance company in Munich rotating out of 10-year treasuries into 7-year notes. Each decision individually means nothing, but together, compounding over years, they represent the largest monetary shift since World War II. Chapter 2. The dollar doesn't lose power when Americans panic. It loses power when foreigners quietly decide to use it a little less each year. This is the silent shift, and it's already happening. In the next 40 minutes, I'm going to show you exactly how this works. You'll learn how the dollar became the operating system of the entire world, how the United States itself triggered the endgame through a specific policy decision in 2022, which concrete steps dozens of countries are taking right now to exit the dollar system, and how this slow-motion transformation will hit American jobs, inflation, home prices, and political stability over the next 10 to 20 years. This isn't prediction. This is pattern recognition. Because this exact sequence has happened before, and the timeline is already set. To understand where we're going, you need to understand how we got here. August 1971, President Nixon closes the gold window. The dollar is no longer convertible to gold. The Bretton Woods system, which governed global money since 1944, collapses overnight. For the next 2 years, currency chaos. Exchange rates swing wildly. Countries don't know how to price their currencies. International trade stumbles. The global economy needs a new anchor. The United States offers one. In 1973, Secretary of State Henry Kissinger negotiates a deal with Saudi Arabia. The terms are simple. Saudi Arabia will price oil exclusively in US dollars. In exchange, the United States provides military protection, weapons, and political support. This is the petrodollar agreement, and it changes everything. Here's why it matters. Every country on earth needs oil, transportation, manufacturing, electricity, plastics, agriculture. Modern civilization runs on petroleum. If oil is priced only in dollars, then every country must acquire dollars to function. How do you get dollars? You sell goods to America. You export to the United States and accumulate dollar reserves. Then you use those reserves to buy oil from Saudi Arabia and other OPEC nations. But what do you do with excess dollars? You can't hold billions in cash, so you buy US Treasury bonds. Safe, liquid, dollar-denominated debt issued by the world's largest economy. This creates a closed loop. Countries need dollars for oil. To get dollars, they run trade surpluses with the US. Excess dollars go into treasuries. This finances America's budget deficits, which allows the US to spend more than it collects in taxes, which keeps the American economy strong, which maintains demand for foreign goods, which creates more dollars flowing outward. It's a perpetual motion machine. As long as oil trades in dollars, the system continues. The benefits to the United States are extraordinary. First, unlimited deficit spending. When you issue the world's reserve currency, you can borrow essentially without limit. Foreign central banks need to buy your debt to hold reserves. This isn't optional for them, it's structural. The US has run budget deficits for decades, currently about $2 trillion per year. In any normal country, this would cause a debt crisis. Interest rates would spike. Currency would collapse. But America is different. Because the world needs dollars, foreign buyers absorb the debt. Interest rates stay manageable. The system persists. Second, exported inflation. When the US prints money, much of that new currency flows overseas. Foreign countries hold dollars as reserves. This means inflation gets distributed globally instead of concentrating domestically. America prints. The world absorbs. Americans enjoy lower inflation than they would otherwise face. Third, sanctions power. If the entire world trades in your currency, you can exclude anyone from the financial system, freeze their reserves, cut them off from international banking. This gives enormous geopolitical leverage. For 50 years, this system appeared permanent, unquestionable. The dollar was the operating system of global finance, and America was the system's administrator. But operating systems can be replaced, monopolies can be broken, and the process has already begun. Financial infrastructure was built to be neutral. Banks clear transactions regardless of politics. Payment systems process messages based on technical standards, not ideology. The dollar's power came from this neutrality. You could trust that dollars held in New York were safe, liquid, and accessible. But over the past 2 decades, the United States increasingly weaponized this infrastructure. It started incrementally. After September 11, 2001, the US targeted terrorist financing. Reasonable, necessary, but the machinery was created, the legal frameworks, the technical capabilities, the precedent. In 2012, the US pressured SWIFT to disconnect Iranian banks. SWIFT is the messaging system that allows banks worldwide to communicate and settle transactions. Being cut off from SWIFT meant Iran couldn't conduct normal international trade. Oil exports collapsed, the economy contracted 9%, inflation hit 45%, the sanctions worked, Iran came to the negotiating table, the 2015 nuclear deal followed. But every country watching learned a lesson. Dollar reserves aren't truly yours if they're held in the US financial system. They can be frozen. Your access can be revoked, not through military conquest, not through default, just through executive order. Then came 2014. Russia annexed Crimea. The US imposed targeted sanctions, not full isolation, just enough to signal disapproval. This was actually a strategic error because it gave Russia 8 years to prepare. From 2014 to 2022, Russia systematically reduced dollar exposure, sold US Treasury holdings from $130 billion down to nearly zero, bought gold, increasing reserves from 1,000 tons to 2,300 tons, developed SPFS, Russia's alternative to SWIFT, negotiated trade deals with China and India that allowed settlement in rubles, yuan, and rupees. Vladimir Putin said explicitly in speeches during this period that Russia was building independence from the dollar system because dollar reserves were unsafe. Western analysts dismissed this as bluster. Russia is too integrated into the global economy. They can't actually decouple. But Russia was serious. February 26, 2022. 2 days after Russia invades Ukraine, the United States and European Union announced the nuclear option. Major Russian banks cut off from SWIFT. $300 billion in Russian central bank reserves frozen. The immediate effect was dramatic. The ruble crashed 30% in 2 days. Russian stock market closed. ATMs ran dry. Western media declared economic victory. Russia would collapse within months. But then, something unexpected happened. Russia stabilized. The central bank hiked interest rates to 20%, halting the ruble's fall. Russia demanded European countries pay for natural gas in rubles, creating artificial currency demand. The ruble recovered all losses within 3 months. Russian trade continued, just through different channels. Oil redirected to China, India, and the Middle East. Settlements in yuan, rupees, and rubles instead of dollars. By late 2022, the Russian economy had stabilized. By 2023, GDP grew faster than Germany or Britain. But the real damage wasn't to Russia. The real damage was to the dollar. Because every finance ministry worldwide understood that the US had just demonstrated it would freeze reserves and exclude countries from the financial system for political reasons. If you're China, holding over $1 trillion in US treasuries, you're thinking, we're not at war with America today. But what if tensions escalate over Taiwan? Could the US freeze our reserves? Obviously, yes. The precedent is set. If you're Saudi Arabia, a US ally for 80 years, you're reconsidering. Your wealth is in dollars. Your security depends on American guarantees. But those guarantees feel conditional now. What if US priorities change? What if a new administration has different Middle East policies? If you're India, Brazil, Indonesia, any major economy, the calculation is clear. Dollar reserves create vulnerability. The US can weaponize your own wealth against you. So what do rational actors do? Exactly what every target of financial weaponization has done throughout history. They diversify, they hedge, they build alternatives, and that's when the 5-stage pattern began. This pattern has repeated 4 times in the past century. Each time a dominant power weaponizes financial infrastructure, the same sequence unfolds. Stage 1. Dominant power controls the system. Stage 2. Dominant power weaponizes it for political goals. Stage 3. Targets build workarounds. Stage 4. Neutral players quietly hedge. Stage 5. The system loses its monopoly. Britain went through this between 1914 and 1944. Britain controlled global finance through the pound sterling and the City of London. When World War I began, Britain seized German assets through the Trading with the Enemy Act. This was unprecedented. Financial contracts had always been honoured even during wars. The immediate effect was devastating for Germany, but neutral countries watched and learned. Their money in London wasn't safe unless Britain approved of their government. After the war, neutral countries diversified reserves. They increased gold holdings. They opened accounts in New York and Paris. By 1944, the dollar had replaced the pound as the world's reserve currency. 30 years from weaponization to replacement. Now the United States is going through the same cycle. We're currently in stage 4, accelerating towards stage 5. Let me show you the concrete evidence that this is happening right now. The shift isn't happening on cable news. It's happening in payment rails, reserve allocations, and trade contracts. Let me walk you through each layer. SWIFT still processes millions of messages daily. Its absolute volume grows each year. But its share of global financial messages is declining. China's cross-border interbank payment system, CIPS, processed $12 trillion in payments in 2020. By 2023, $27 trillion. That's more than doubling in 3 years. CIPS now connects over 1,400 financial institutions in 110 countries. Russia's SPFS processes about 2 million messages per day domestically. India's Unified Payments Interface handled 12 billion transactions in 2024, with growing cross-border volume. These aren't theoretical systems. They're processing real transactions, real trade, real money. SWIFT is no longer the only game. It's one option among several, and each year, more volume shifts to alternatives. Foreign exchange reserves are the savings accounts of nations. Central banks hold reserves to stabilize currencies, back imports, and ensure financial security. For decades, reserves meant US dollars and treasury bonds. But the composition is shifting. The dollar's share of global reserves fell from 71% in 1999 to 58% in 2024. That's a 13 percentage point drop, representing trillions in diversification. More importantly, the pace is accelerating. The past 2 years saw a 4 percentage point decline, faster than any period since the 1970s. Where is the money going? Gold, primarily. Central banks bought 1,136 tons of gold in 2022, 1,037 tons in 2023, over 1,000 tons in 2024. 3 consecutive years of massive purchasing, the highest sustained buying since Bretton Woods collapsed. Who's buying? China, Russia, Turkey, India, Poland, Singapore, Czech Republic. These aren't marginal players. They're major economies converting dollar reserves into an asset that can't be frozen or sanctioned. For 50 years, international trade contracts were written in dollars. An oil tanker from Saudi Arabia to Japan, priced in dollars. A shipment of machinery from Germany to Brazil, invoiced in dollars. This is changing, not everywhere, not all at once, but the cracks are widening. Russia-China trade hit $240 billion in 2023, almost entirely settled in yuan and rubles. Russia-India trade, $65 billion, largely in rupees. Saudi Arabia accepting yuan for Chinese oil purchases. UAE accepting dirhams and yuan. Iran selling oil to China in yuan. Each bilateral agreement is small compared to total global trade, but together they establish proof of concept. You can conduct massive international trade without dollars. The plumbing works, and once countries know the plumbing works, the question becomes, why use dollars at all? Why hold currency that can be frozen? Why route payments through systems you don't control? The answers are getting weaker every year. BRICS started as an acronym describing emerging markets: Brazil, Russia, India, China, South Africa. But it's evolved into an actual geopolitical bloc-building parallel infrastructure. In 2023, BRICS expanded to 9 members. The original 5 plus Saudi Arabia, UAE, Iran, Egypt, and Ethiopia. These 9 countries represent 45% of global population, 36% of global GDP, and 42% of global oil production. At the 2023 BRICS Summit in Johannesburg, members announced plans for a common payment system and discussed a shared currency backed by commodities including gold. This isn't implemented yet. The details remain vague, but the signal is unmistakable. The world's major emerging economies are building financial architecture that doesn't depend on dollars or Western institutions. China leads this effort through sheer economic weight. China is the world's largest manufacturer, largest trader, and second largest economy. The yuan is becoming a reserve currency by default, not because countries love China, because China offers what they need: an alternative. Russia provides proof of concept. Russia showed you can survive swift cutoff and reserve freezing. This demonstration effect matters enormously. Every country that feared US financial power now knows survival is possible outside the dollar system. India adds democratic legitimacy. India is the world's largest democracy, a rising economy, and deliberately maintains strategic autonomy. India's willingness to trade with Russia despite Western pressure shows middle powers can chart independent courses. Saudi Arabia and UAE bring energy. Their participation signals that petrodollar exclusivity is ending. If the Gulf states accept multiple currencies for oil, the structural dollar demand that's existed since 1973 evaporates. Gold anchors the entire alternative system. Gold has no counterpart. Gold doesn't care about sanctions. Gold is trust in physical form, and central banks are buying gold at rates not seen in 50 years. None of these pieces alone kills dollar dominance. Together they create an exit ramp, and dozens of countries are taking it. Let me bring this back to ground level. Back to you. You open your banking app. Your balance looks the same. Maybe you've got 15,000 in checking, 60,000 in a retirement account. The numbers are stable. You feel secure. But beneath those numbers, the foundation is shifting. Your bank's deposits are backed by assets. Many of those assets are US Treasury bonds. Safe, liquid, government guaranteed. But those bonds are only valuable because foreign central banks buy them. Foreign demand keeps yields low and prices high. What happens when foreign demand fades? Right now, foreign holders own about $8 trillion in US Treasuries. That's about 30% of total federal debt. These foreign buyers allow the US to run massive deficits without catastrophic interest rate spikes. But foreign treasury holdings have plateaued. China's holdings fell from 1.3 trillion in 2013 to 775 billion in 2024. Japan's holdings are roughly flat. New buying is slowing. When foreign demand weakens, 2 things happen. First, interest rates rise. The government must pay higher yields to attract buyers. Second, domestic buyers must absorb more debt. That crowds out private investment. Higher interest rates ripple through everything. Mortgage rates rise. A 30-year fixed mortgage that was 3% in 2020 is now 7%. That doubles monthly payments on equivalent houses. Home ownership becomes less affordable. Housing prices stagnate or fall. Credit cards become more expensive. Business loans cost more. Companies invest less, hire less, pay less. Economic growth slows. Federal spending faces brutal choices. As interest on the debt rises, it consumes a larger share of the budget, currently about 15%, heading toward 25% within a decade if trends continue. That's money that can't go to Social Security, Medicare, defense, or anything else. Politicians face impossible choices: cut popular programs, raise taxes, or print money and accept higher inflation. Most will choose inflation. It's politically easier. You can blame corporations, foreigners, anyone except yourself. But inflation is a tax on everyone holding dollars. Your salary might go up 3%, but if prices rise 5%, you're getting poorer. Over a decade, this compounds devastatingly. The same middle-class salary buys steadily less. Housing, food, energy, healthcare all rise faster than income. The American standard of living, which has been subsidized by dollar privilege for 50 years, begins eroding. This isn't sudden. There's no single crisis day. It's a slow grind, each year slightly harder than the last, and here's what makes it politically explosive. Most Americans won't understand why this is happening. They'll see prices rising, wages stagnating, government services cutting back. They'll demand answers. Politicians will provide scapegoats. Immigrants, China, the rich, the poor. Anyone except the real cause. The end of dollar privilege that allowed America to live beyond its means for decades. This economic stress fuels political polarization. Radical proposals from both left and right gain traction. Trust in institutions collapses further. The social fabric strains. This is the domestic endgame. Not hyperinflation, not societal collapse, just grinding economic pressure that feels like nothing's working anymore. And nobody in power seems to understand why. The trajectory is set, but the endpoint isn't. Let me sketch 3 scenarios. Scenario 1, managed descent. In this path, American leadership accepts reality. The dollar will not remain dominant forever. Better to manage the transition than fight it. Policy shifts. Fiscal. Discipline returns. Deficits shrink. Investment focuses on domestic productivity, infrastructure, education, technology. The US negotiates roles in new multilateral monetary institutions instead of opposing them. The dollar remains important, but not supreme. It settles to maybe 40% of global reserves, comparable to the pound sterling's position in the 1960s. Still significant, still useful, but no longer hegemonic. American living standards adjust downward to something closer to typical developed nations, still wealthy by global standards, but not the exceptional consumption paradise subsidized by money printing. This is the soft landing. It requires political courage and long-term thinking. Both are rare in democracies. Scenario 2, denial and escalation. In this path, the US doubles down. More sanctions, more financial weapons, attempts to force allies into exclusive dollar arrangements, capital controls to prevent outflows. This works tactically in the short term. Countries fear being cut off. They comply. But strategically, it accelerates de-dollarization. Every new sanction convinces more countries they need alternatives. Every weaponization of finance speeds up the shift to BRICS systems, currency swaps, and gold. The dollar's share of reserves falls faster, maybe to 45% by 2030, 35% by 2035. The advantages disappear more quickly. The pain hits harder. This is the hostile decline. It breeds resentment internationally and confusion domestically. Why is everything getting worse despite America's strength? Scenario 3. Shock event. In this path, gradual erosion turns suddenly visible through a crisis. Maybe a treasury auction fails. Foreign buyers don't show up. Interest rates spike. Panic selling ensues. Maybe a geopolitical shock. Conflict over Taiwan. China dumps treasuries. Dollar plunges. Maybe a loss of confidence spiral. Inflation expectations shift. People flee dollar-denominated assets. The dollar falls 20% in weeks. Even in a shock scenario, the underlying story is the same. Years of silent shift suddenly become visible. The slow erosion hits a tipping point and cascades. Shocks are impossible to predict, but the longer the silent shift continues, the more fragile the system becomes. Let me be clear about what this video is and isn't. This is not investment advice. I can't tell you to buy gold, Bitcoin, foreign stocks, or anything else. Those are individual decisions based on personal circumstances. This is not a call to panic. Dollar collapse is not imminent. The system has enormous inertia. Change takes decades. This is an explanation of structural forces that will shape the next 20 years. What you can do is adjust your mental model. Stop thinking of dollars in a bank as a timeless, safe asset. Think in terms of purchasing power, not account balances. Understand how your country is positioned. If you're American, recognize that living standards have been subsidized by dollar privilege. That subsidy is ending. Prepare emotionally and financially for a world where America is a normal, wealthy country, not a superpower that prints the world's money. If you're outside America, understand the shift creates opportunities. Multipolar currency systems give middle powers more autonomy. You're less trapped in dollar dependency. Think about civic implications. The end of dollar hegemony means fiscal reality matters again. Politicians can't deficit spend indefinitely. Voters must care about productivity, deficits, and industrial policy, not just culture wars and personalities. Educated citizens who understand these forces will make better decisions. That's the best preparation. Let me return to where we started. March 2023. Saudi Arabia accepts yuan for oil. Now you understand what that headline actually meant. It wasn't just one trade deal. It was the visible rupture of a 50-year monopoly. It was proof that the petrodollar system is ending. It was a signal to every central bank that alternatives exist and work. The dollar will not collapse like a building in an explosion. It will erode like a shoreline, pulled by different tides every year. The silent shift is already in motion. Payment systems are fragmenting. Reserves are rotating. Trade contracts are changing language. Gold is returning. BRICS is building alternatives. None of this is secret. It's all happening in public. Central banks publish reserve data. Trade statistics are available. You just have to look. 20 years from now, historians will write about this period. They'll debate exactly when American financial dominance ended. Some will point to February 2022 and the Russia sanctions. Others will highlight the Saudi yuan deal in March 2023. Others will identify the moment dollar reserves fell below 50%. The exact date matters less than the pattern. Financial weapons always backfire. Britain weaponized the pound in 1914, lost reserve status by 1944. The US weaponized the dollar, and SWIFT in 2022. The pattern suggests loss of dominance by the early 2040s, maybe sooner because technology accelerates everything. This isn't the death of America. It's the end of a particular kind of empire. An empire built on monetary privilege rather than territorial conquest. That empire is dying. Not with a bang, but with a silent shift nobody notices until it's too late. The United States had the golden goose, dollar privilege, unlimited borrowing, exported inflation, sanctions power, all granted by being the issuer of the world's reserve currency, and the United States strangled that goose with financial weapons, cut Russia off, froze reserves, taught the world that dollar dependency is vulnerability. China didn't defeat America. America defeated itself. If you understand the endgame early, you're not powerless. You're simply one of the few who can see the script everyone else is still acting out. The silent shift is happening. The timeline is set. The dollar's endgame has begun. And understanding this won't stop it. But it will help you navigate what comes next. Because the post-dollar world is coming. Not today, not tomorrow, but sooner than most people think. And when it arrives, those who saw it coming will be the ones who adapted successfully.